This is Heather Raney with Atlantic Bay Mortgage. And Heather, there's all kinds of talk about mortgage rates lately. And on the realtor side, it feels like people have had their hands in their pockets kind of waiting for that rate to continue to drop. What have you been seeing happening?
Well, it's like anything, there's no perfect time because timing it is literally at a blink. Tomorrow, it could be completely one way or the other. So waiting for the rate to drop, the first part is understanding what's happening.
Yeah.
The second part is to understand what's really happening. And then knowing that there's really no right or wrong answer because it's really all about what you need, not what the market's going to do. I've never met anyone that decided to buy a house just because nobody wakes up tomorrow morning and goes, oh my God, the rate's 5%. I need to sell my house and buy one.
Yeah.
That's not what drives it. So understanding that rates, similar to the way you buy a stock, today the stock might be you may buy it at $4 and tomorrow it might be at $8, but tomorrow it could be at $2. Mm-hmm. It ebbs and flows the same way because it's market driven.
Yeah.
The second part to that is what's actually happening when rates drop is typically what's moving is the cost of the rate. And I use this analogy with everybody because it's such a simple depiction of how it's happening. So when you go to the grocery store to buy milk, there's a variance of types of milk, sizes of milk, brands of milk, and they're not all $3. They're $2.50 and $4.79 and this, that, and the other. And there's almond milk and regular milk and 2%. And there's all these different variances of that. Well, think of the milk as the interest rate. The interest rate is the product that a mortgage company or bank is essentially selling. Mm-hmm. So when you look at the rate as a product and knowing that there is a cost associated with it, what's actually happening when rates drop is the cost is dropping. So a rate at 7% may be what they call par rate, which means it doesn't pay anything and it doesn't cost any discount points. Mm-hmm. Well, tomorrow it might cost a quarter of a point, and now par is 6.75. Well, that quarter of a point is what actually changed, not the rate itself, which is why you hear people talk about discount points, because essentially you can buy the milk you want, provided you qualify. Mm-hmm. But you have to know that that's where discount points come in, and it'll come at a cost. Mm-hmm. If you like almond milk and it's $4.79, but you want to pay $3, well, you're either not buying almond milk or you're paying the difference.
Right.
That's kind of the same concept. So you can get 6.5. It just may cost you one discount point or 1% of your loan amount, or you can take a 6.75 or a 7 or whatever, and it might not cost you anything. And that's less money out of pocket. So understanding that piece is what helps you make better decisions. So I always try to explain that to people.
Yeah. And, one thing that I think a lot of people get wrong is that when the Fed decides to drop the rate, everybody says, oh, great, housing rates are dropping too. Is that what you hear on your side when you deal with this every day?
All the time. So there's so many pieces to the mortgage side. But when you talk about money, there's so many nuances. But yeah, so the Fed fund rate it's not that there's not an impact of some nature, but we're usually already accounting for that. So there's a section of the mortgage world called secondary marketing, and that's what they are doing, is they are following those kinds of things to know what to price our milk at, essentially. So when the Fed fund rate drops a little bit, where you're going to see your impact is going to be in your short-term lending, car loans, home equity lines, credit card rates specifically. Those are where banks borrow money to lend, and that's their cost on lending money. It's where they're borrowing it. So the second part to that is not that there isn't some impact, but when you're looking at long-term lending versus short-term lending, when the short-term lending rates go like that, when they if they reduce some, then that's also where you're going to see impact on your savings accounts and your yield to the
Mhm.
money back to you.
Right, right, right.
So, because it causes people to spend more.
Mm-hmm.
So when economy generates from
Yeah.
short-term lending rates going down and stuff, then you tend to long-term rates will shift a little bit, but they're not going to be all of a sudden a point lower tomorrow or a complete quarter point lower tomorrow. That those things are already being accounted for through our any secondary marketing. That's what they do.
Yeah.
So
Now, what was it last year or the year before where rates were like incredibly high and it was just a real hardship, on people to try to get a loan and, pay. That's why many of them didn't want to sell, right? They're locked in with these 3% interest rates and they were
yeah,
looking at moving to a smaller home with a higher interest rate and their mortgage is the same.
yep.
So, how are interest rates comparing to where they were just a bit ago? I know they've come down, but what's the general mood? I mean, is it pretty? Is it a good rate? People just aren't used to it yet, or how are we looking?
Yeah. Yeah. So I always use experience, personal experience. That's the best teacher. It's the best thing I can speak from. And just, it's only been 20-ish years since my first home I ever bought. When I bought that home, I bought it, the interest rate was it was either 7.75 or 7.875.
Hmm.
The loan amount was a lot smaller because prices were a lot smaller. The rate part is not really what's changing that's making it more costly. It's because it's in conjunction with prices being so much more than they were 10, 20 years ago.
Yeah.
So it's definitely twofold. But the rates from a year to 2 years ago, when they were 7.5, 8, even as much as 8.25, they definitely have trickled down, but they're slowly trickling down. I feel like we're going to run the gamut about another point total over the next 12 to 18 months. Then I feel like we're going to settle in that sort of sweet spot for a while. I think anything in a 5 and a 6 range is a great interest rate.
Hmm.
Um, and the main reason is because if you look at the history of rates, even on like I said, even on a 20-year short term,
Yeah.
um, you're still looking at 2 points, 2 points, 2 percentage points better than they were 20 years ago, let alone 40 years ago when they were 13%.
Hmm.
So it's definitely something that is hard to time. And it's definitely something that if you are looking to purchase, a lot of people say marry the house, date the rate or whatever.
Yeah.
And to some degree, that's essentially what it can feel like you're doing.
Yeah.
But money is a tool to do things, and learning and navigating the best way to use that
Hmm.
to accomplish what you want to accomplish. A refinance doesn't have to just be refinancing to lower your payment. And again, I speak from experience. We refinanced our house just 2 years ago, and that's the second time we've done it in 11 years. And all we did was shorten the term and shave 4 years of payments off our mortgage, and we're
Yeah.
paying essentially the same payment. But
Hmm.
now I'm paying my house off faster, but I'm
Yeah.
not paying really any more money. So
Hmm.
you having this people behind you to help support navigating things like that to say, okay, yeah, I know you're not saving anything, but you're shortening your term,
Hmm.
or maybe it's a combination of these things. So being strategic is what makes a big difference in the long run.
When do people know when it's a good time to refinance? Do they look for a certain amount of rate drop from where they are? Or how would you gauge that if somebody called you up and said, I want to refinance? Will that help me at all? Because I know there's costs associated with that, right?
Yep, there typically is. They are usually a lot less because you are not there's not like a bunch of like new escrows. There's not, it's not the initial deed recording with the attorney. It's a lot of
Hmm.
things are redone. So it's more time is what you're paying for.
Hmm.
But there is a cost associated with it typically. But really honestly, with refinancing, I think it's one of them is life changes and life things. And the longer in your home, the more you're all of a sudden now wanting to make changes to it, or
Hmm.
maybe you have kids going to college, or maybe you have kids now out of college,
Yeah.
and all these different things, or maybe unfortunately you got divorced, or maybe you're getting married and it's a blended family. Like all these different things happen, and I think it's one of those that it has to make, to me personally and professionally, it has to just make sense.
Hmm.
whatever that looks like. Maybe, you know, debts have come up and now you're paying. I mean, I had a client that called me back in, it was probably Mayish. I think it was May. And just over the course of time with a newer baby and all this, they had accumulated a lot of credit card debt and
Mhm.
they were just exhausted from paying out so much in interest rates and payments and trying to control all of the cash flow
Mhm.
that, yeah, we went back to a 30-year, but we paid a lot of this debt off and now they have one payment. It's manageable. They've increased their cash flow by like almost $800.
Wow.
Just because of the other interest. It had nothing to do with the interest they were in. They were in like a
Mhm.
3.5 and they went to like a 6 and some change.
Mhm.
But getting rid of all that negative equity type debt
Mhm.
really helped them out.
Yeah.
So it's all about what your needs are.
Yeah.
So being
Well,
strategic.
yeah, and also just, I mean, the importance of building equity in a home. You know, some people that have been afraid to make that leap from renting to buying because of the interest rates are still renting and not keeping any of that money in equity or anything else. So,
Yeah,
you know, it's if you can find a way to do it, you know, the homes, if we've as we've seen, the home values keep going up. So interest rates go up and down, but the home values still appear to be going up. So that's a good thing.
absolutely. And you know, renting is for a lot of people. I mean, it makes sense in some cases,
Yeah, that's true.
but it also could make sense that you buy, even though you may know you're only going to be there 3 years, and then you make
Mhm.
that your rental for someone else.
That's
So
true too. Yeah. Yeah. There's
again, it's all
definitely a
about
strategy to it.
yes,
Yeah.
and I will say the renting piece of that. I mean, rents now in our area, especially, are for a decent 2-bedroom apartment. If you're a family, you're probably going to be $1,800 plus a month. I
Mhm.
mean, you can get a reasonable home still for you know that $1,800 to $2,000 typically.
Yeah. Yeah.
If you stay, one of the keys I will say is stay a little flexible. If you
Mhm.
want to be in Simpsonville, okay, we'll know that Simpsonville's only like 5 minutes from Fountain Inn, or 5 minutes from Malden, like, or 5 minutes, 10 minutes from Duncan. If you be flexible, it can
Yeah.
really open up your opportunities. And
That's right.
and there's so many ways to make the mortgage part work with down
Mhm.
payment assistances, and you know that's not always a great avenue, but it is an avenue to look at.
Mhm.
um, Different programs, products, down payments, it all exists, so we just have to find the right thing.
That's what I was going to ask you about next, because there are so many different ways to go about getting a loan, so many different types of loans. I think many people are familiar with conventional, they've at least heard of FHA, VA loans, jumbo loans. Can you give us just a quick summary of each of those and like the differences between those?
Yeah, so um, conventional is, we call it vanilla because it's, I mean, pretty much the nuts and bolts of the basics.
Mhm.
um, they do have low down payments, but typically that's going to be higher down payments. um, they tend to have higher credit scores, and they can have higher or lower rates comparatively to government programs, just depending on the circumstances. Fannie Mae and Freddie Mac have these things called low normal price adjustments. So there's so many variables that can dictate the parameters of your loan, which can change all these little things. So whether it's loan amount or occupancy or whatever. Um, FHA, VA, and USDA are all government backed programs. They tend to carry a little more leniency when it comes to credit scores, debt to income. Um, they tend to come with lower interest rates. They do, however, mm, at least FHA, it can come across as higher mortgage insurance. Um, that's a piece of the puzzle that you have to consider when you're talking about payment on all accounts. But governments government loans like FHA are a really great option, especially for first timers, because of the lower MI and the lower interest rates. It helps to kind of keep your payment a little lower.
Mhm.
But usually, if you're doing FHA, you'll look at refinancing probably a few years later to get out of the mortgage insurance and get and utilize that equity that you have if you're staying in the home.
Yeah.
If you're selling, obviously that's moot. But
Yes.
um, but there's also things like jumbo products are your anything that's over your um, your loan limits for Fannie and Freddie. So they're going to be $850,000 plus. You have, there's also investor loans and brokered loans. What that means is we may not do it in house, but we may have an investor that does something. For example, I have a bank statement loan going right now, which means we're using all these bank statements from the last 24 months
Yeah.
to accumulate an income based on their deposits. So, I mean, and there are different things that all these things
Yeah.
have guidelines that follow, but just as an example of just a anomaly type option that we're doing. So yeah, there's a lot of avenues.
So, yeah, that's a really good explanation, and kind of underscoring all of that is the credit score, right? And is that the bane of your existence sometimes, like just encouraging people to get that credit score? Is that a lot of times the roadblock for people to accomplish their goal? Or is it something that they're like, okay, we'll be back, we're going to work on it, and then they check in with you again?
I think it's both. I don't I don't know that it's the bane of my existence most days, but and it's not always the biggest hurdle because this would be a time that we would look at definitely doing maybe government loans because they do have a little more leniency for credit specifically. But for example, if your credit score is at say your middle credit score, because there's three. If the middle one, which is what we use, is say 659, but at 660 you can get a better situation, then I'm going to try and work with you to say, hey, what can we do to get this done and knocked out, and we rescore it, and we or whatever, or
Yeah.
wait 30 days, and let's try and get this score up over the hump, and let's get you a better position. It's not just about getting it and running with it if we can make it better.
Right.
Um, the second part of that is it's not the biggest hurdle. The biggest hurdle tends to be down payment. Um, and it's just across the board. I think a lot of people in this, in the last handful of years, the economy, the spending, the inflation and the expense of things, wages still, for a year, 2 years, 3 years, kind of being stagnant. I think that's the biggest hurdle that I see these days. So it's just about starting somewhere with savings. I tell this story about my husband all the time, and he always is like, why do you tell that story? And I'm like, because it's relatable to everyone probably. And when we met, his idea of saving, just because he wasn't thinking of it in a bigger term, is he didn't want his checking account below $300. And I said, but Justin, then you'll never have 300. You'll never have more than $300. I
Yeah.
said,
Because
I don't
you'll know
care.
that. You'll sense that freedom to spend the rest, right?
Yes. And I said, so even if you just take $25 a check and just put it somewhere. And I don't mean like at the savings account with your regular bank, because you'll see it and you'll dip in it. If you put it somewhere else,
Yeah.
I always recommend an online savings, like an Ally or I think SoFi is another online bank. But anyways, another bank where you're not seeing it all the time, that gets a good interest rate. Not that I'm a financial advisor, please note that.
Yeah.
But just putting that little hinges swing big doors, I always heard. So if you just put that little bit, you won't notice it, and it'll chip away and chip away. And next thing you know, you've got a couple $100 in there. And now you don't want to spend it as easy because it took you so long to get it. It
Yeah.
starts to become, a good thing. And so I always tell that story about Justin because it's so applicable to so many people. You just have to know and consciously realize you can do it. You just got to start small and then grow.
And it's best, you're right. It's best when you can't see it growing, because when you see it growing, it's, yeah, you want to keep doing it because it took a lot to get there. But then you're like, oh, I actually can afford those new AirPods, or just something that's been on your mind.
100%. I mean, I literally have been looking at boots. I need some new tall boots. And I was like, oh, I really want these boots. And they're $170. I was like, or do I? So I mean, we all struggle with it.
We
It's not
do.
just
Every single one of us.
yeah. So I love telling that story though, because everyone's like, oh my God, yes, I feel like that's what I do. And
Yeah.
you just have to get it out of sight.
Right, right. So save up for the down payment as you're getting closer to closing, and you've secured your loan and we're down to the final checks. Don't you usually tell people, don't go on any vacations, don't go buying furniture, because there is another credit check towards the end. Is that right?
It's not really it's not a credit check at the end. What they do is it's a monitoring, and it's watching for if your credit is pulled for new debt. So when you do a mortgage credit report, if you're going and you're applying it, let's say your local bank of Bank of America, and then you come to me, well, basically we should get the same report essentially.
Yeah.
It might be a little different, but they're cumulative. Anything you've ever had in your name will be on it. Whereas if you're going and getting a Lowe's credit card and then you're going over here and getting a Best Buy credit card, those are retail credit pools, and they are because those can be they are credit that can be extended just like that. And so if you do that and run it up, now your credit scores are going down. So it is important that you're not going out and just buying stuff. Always check with your loan officer or banker or whoever you're using before you do something like that. But yeah, I mean, things have to be bought. Everybody's conscious about that, but just don't be, you don't necessarily want to open up new credit. You definitely don't want to go buy new cars or take out new leases. Anything that'll change that debt to income ratio, because whether you're on the cusp or not, that could be the difference of not closing.
Yeah.
So,
wow. Okay. All right. So, final question here. Usually as realtors, as we get into holiday season, I'm sure you probably see that in the activity too. Everybody kind of settles in. The activity overall seems to go down, and then it wakes up again as we get into the early spring for the spring market. Um, do you have any type of forecasting quotes on how next year is looking compared to what we've seen based on the interest rate, the mortgage rates and things like that? Or like you said, it just kind of depends on what happens next in the news?
I think it's a little bit of all of it. I mean, that's one thing that it definitely, the market, mortgage-backed securities, which is where rates are derived from. Essentially, they follow the movement. They tend to follow the movement of the 10-year Treasury yield. But all that jargon, not to bore anybody, but meaning just like I mentioned, stocks. It's kind of the same concept. I mean, you forecast what you can forecast.
Right.
There's all the pros and stuff out there that and experts that say whatever, but nobody really knows. I mean, who knew we were going to have a COVID situation and all of that happened?
Yeah,
so
that's true.
You just don't know. But I will say what I feel like is happening or going to happen. I feel like depending on what I actually kind of think, depending on what the economy does and the expenditures over the holiday season, because they follow that, retail sales and what people are buying and how much is being bought and all that. Yeah. I think as we get into the new year, like I said, I do foresee rates coming down a little bit more probably. But just like every supply and demand, once demand starts picking up towards the spring and stuff, I don't feel like we're going to be much higher than we are now, but I think we're still going to be settling around this, cusping on this 5 to 3/4 to 6 1/4. I just think that's where we're going to ebb and flow. And to understand the basic math of getting wrapped up in a rate of, I got to have a lower rate, just note that 1/8 of a point on $100,000 is not a lot.
Yeah.
so even on, a $200,000 or $300,000 loan, 1/8 of a point or 1/4 of a point is not really a huge difference. So definitely don't lose something being caught up in something as simplified as 1/8 of a point or 1/4 of a point. So, because you can always change that. You can always refinance or whatever later.
Yeah. That's true. So yeah, the people that are deciding to sit on the sidelines until rates are down to 3% again are going to be waiting a long time, huh?
Yeah, because that was a real true anomaly.
Yeah, it was crazy. Well,
yeah,
very good. This has been great information, Heather. Thank you so much. And remember, if y'all need help with getting a loan, you can certainly talk to Heather Raney with Atlantic Bay Mortgage. And Heather, thanks again for being here today.
Yeah, Christy, thanks for having me.